I asked a personal finance expert a simple question that millions of people Google every year. How should I invest? He smiled and said something that stopped me cold. Most people don't fail because they pick the wrong investment. They fail because they invest with the wrong identity. That sentence stayed with me, because the shocking truth is this. Over $7 trillion sits idle in cash globally, losing value every single year to inflation. Not because people are lazy, but because they're confused, scared, and chasing the wrong signals. And what he told me next flipped everything I thought I knew about money. He started with something uncomfortable. People think investing is about intelligence. It's actually about behavior. He explained that the average investor earns 3–4% less than the market over a lifetime, not due to bad assets but bad timing, buying when headlines feel exciting and selling when fear feels unbearable. Most people treat investing like a reaction to emotions, not a system. They wait to feel ready. They wait for certainty. They wait for the perfect moment. But money doesn't reward certainty. It rewards consistency. The expert said the real investors don't ask, "Is this the best time?" They ask, "Am I still playing the game?" And right when that hit, he warned me, this is only the surface mistake. The deeper one is far more dangerous. Then he leaned in and said something almost no one talks about. Your culture teaches you to save money. It rarely teaches you to deploy it. In many households, cash is treated as safety, not as a tool. But here's the hidden cost. $10,000 sitting in cash for 20 years at 3% inflation quietly shrinks to the equivalent of about $500 in purchasing power. No crash, no drama, just silent erosion. The biggest mistake people make is thinking risk only exists in the stock market. The expert reframed it for me. Not investing is also a risk, one that feels comfortable but compounds damage over decades. What to do instead? Start thinking like an allocator, not a saver. Every dollar should have a job, growth, protection, or cash flow. And if you don't assign it a role, inflation will assign it a penalty. But even that mindset shift isn't enough without the next rule, and this one surprised me the most. He said, if your investment strategy depends on motivation, it will collapse. Motivation fades, systems don't. Most people promise themselves they'll invest when income increases or when life settles down. Statistically, that moment almost never arrives. The expert showed me data where automatic, boring investments, done monthly, outperformed high-effort, high IQ strategies over 25 years. The real advantage wasn't returns. It was friction removal. People fail because every decision feels heavy. Successful investors design systems where doing the right thing is the default. And just when I thought that was the final insight, he ended with something that reframed everything. Investing isn't about getting rich fast, he said. It's about becoming someone who doesn't panic. That's the transformation, from reactive to deliberate, from emotional to mechanical, from chasing tips to building endurance. When you stop trying to outsmart the market and start outlasting it, money begins to work quietly in the background of your life. And that's the real goal. Not flashy wins, but financial gravity pulling you forward even when you're not watching. If you apply what he shared, you don't just build a portfolio. You build patience, clarity, and long-term power. And that's how investing finally starts working for you, without stress, without noise, and without regret.